for me, the only gym I go to is Jim Beam.
Yeah.
But if you're going to go to another gym,
I'm going to graduate
totally
there with you.
respect it if it's a boxing gym to make the beer taste better. That's the behavior of a true econoholic. That's drinkonomic thought.
I know, it's a really drinkonomic thought. So, like, I mean, I don't know, like, you know, why not do whatever I can to make the beer taste that much better? Not that it needed the help. I'm just saying, you know, it's, you know.
But it does taste better, so why not?
Why not? Yeah, thank you.
Yeah.
Did you know that over $5 trillion exchanges hands on a daily basis? That's an average of over $220 billion an hour. Now, how does this much money move every single day, and why does it move the way it does? Here on Drunkenomics, two bartenders who also happen to be students at the University of Nebraska Graduate School of Business are going to sit down and drink to the global economy and try and translate it into English. So sit back, relax, pour yourself a stiff one, and have a drink with us to the comedy that is the global economy.
Guys, welcome back to Drunkenomics, the drinking podcast with an economics problem. I am your less gracious... Nope, that's not right. I am your more gracious host. I just felt like I had to say less gracious.
I know you're getting tired of it.
I want to get back to bread and butter. I think it's because I've gone back home. So I'm in Orlando right now. For those of you wondering, I am back in Florida until the middle of next week. Yeah. So if you happen to be in Central Florida area,
say hello.
Send me something on Instagram somewhere in the metaverse,
LinkedIn,
any of our social media, LinkedIn, all of it, any of it, and I'll do my best to go hang out with you.
Yeah. That's all at drunkenomical, DRUNK, my CAL. You can reach out to either of us there. So
that makes I guess I've gone back to my roots, so I just assumed I was the less drunk, or the less gracious host, the more drunkenomics host.
If the shoe fits, right? Or if the flip-flops fit.
The flip-flops fit. Little FFF action for you. Yeah. So that makes me James Goldwater.
Yeah, it does.
And then, of course...
Yeah, no excuses. The VIX is at 2837. I'm the less gracious host. You're the more gracious host. And my name, that makes me...
Like I said, I'm back in like my home waters, so I just assumed I was less gracious again.
Yeah.
It's on me, folks.
Yeah, it's okay. I forgive you. I forgive you, man. Yeah. But, this implied volatility doesn't make any sense.
Well, no, it makes perfect sense.
It makes complete sense.
Because nothing else makes sense.
Yeah. So, I guess there's so many things to talk about, and speaking of which, if you want to join the conversation, feel free to find us on the Discord too. That's also on our social media pages. It's free to all.
There.
It's free to all, man. Just
come and
why
join
not?
us.
Talk a little trash to us.
Talk to others. Ask us questions.
Yeah.
We try to be socially engaged with everyone. So
if you have any input, insight, feedback, whatever it is that you want to drop in, you can do it there. You can DM us, whatever. We're always happy to hear from you, I think. But yeah, should we start with what's real estate? I think real estate's
So obviously real estate's booming in the U.S. We could definitely call that some sort of bull market, maybe a bullshit market, but that's only because we're propping it up.
It has calmed down a little bit in the U.S.
Just because it's calmed down doesn't mean it's not bullshit.
No, I totally agree with you.
But hang on, bear with me, Aaron, and let's talk about
I'm bearing with you, man.
Unintended.
I'm bearing with you, man.
So Goldman Sachs came out this last few days, and they've increased the default expectancy in the Chinese real estate market from 19% to 31.2% in the dollar-denominated debt.
Yep.
They based on the fact that 22 of the high-yield dollar bonds have either defaulted or are in deferred repayment currently, using bond swaps to defer those payments. But it's when you have 22 high-yield bonds that are in default or in deferment. Yeah, I think that's a pretty good reason to suspect that there's a bear market on the horizon.
Well, I mean, there was an article that came out a long time ago, and this was back in like February, which said China's property developers are seen having a hard time accessing U.S. bond markets.
And at this rate, yeah, absolutely, they should be. Why on earth? Like, in order to go into knowing that there's 22 others that are high yield but that are not paying out. You'd have to give me a fantastic discount to get me to put money,
right?
And that creates and therein lies the problem. They need huge amounts of cash. So if they give you that fantastic discount, let's say for some reason they were willing to sell me a $1,000 bond, face value bond, for $100.
There was actually one that did trade at that. I'm not even kidding.
Well,
I literally saw a bond with a yield of like a Chinese bond with like a yield of like 1,000% or something like that. It was trading at like $170.
Yeah, but think about it. Like if you got me down there, if I'm giving you 20% of the cash that you're going to pay back to me in whatever the period of time is, let's call that a 5-year or 10-year. I'm still sitting here going, well, fine. All you're doing is kicking that can down the road because everyone else is buying into this too. And I don't know where you're going to come up with the excess $800 per bond.
Yeah. Well, and this is the thing. It's like this bond wasn't even
whole.
Yeah, but I think the bond quote that I saw was actually I mean, it had to have been like on the secondary market. There's no way that this was actually like a newly issued bond with a coupon.
No, there's no way there's a primary market buying it.
Yeah, it was like a 7% coupon, and it was trading at like $170 or something like that, which I'm like, wow.
In theory, if all you're buying is the coupon payments, that might be worthwhile. If the coupon payments are being made.
Yeah, so it goes to show like the risk of lending to Chinese real estate developers. I mean, that's essentially what that is.
Absolutely.
Right?
That's all script is. It's a slightly more universal, formal loan that isn't a note.
I mean, the way I look at it is like, okay, so if I'm lending money to a certain geographical area and there's a 1 in 3 chance that they're going to default, think about it this way. Like if you're like a mortgage loan officer or something like that, and, someone applies for a mortgage and then you look at their credit score and it's like a 480 or whatever a bad credit score is. It's like, all right, well, I'm not going to charge you 3% interest.
Yeah, because I have to charge you a lot more. I have to cover my.
Yeah, if there's
I have to assume this loan will fail, and I need to make my money back.
Yeah, exactly. Which is why, like, okay, if you're going to take on that risk of loaning money to someone with not a good credit score, aka China, or if you're a loan officer and you're loaning money to someone with like a 480 credit score, it's like, okay, yeah, there's going to be premium on that risk, which is kind of like what we talked about last week, the risk premium.
But, but it's slightly different.
I don't know.
It's a little more active.
Yeah.
Let's put it this way. My sentiment for any kind of Chinese real estate, bond, security, anything else, I want to say it's 0, but I'm willing to bet that there's like a 5% of me that's like, if they were willing to sell me $1,000 bond for $10 and pay a 20% coupon, and they paid the last coupon, I'd probably buy it at that discounted rate because that's obscene. There's no reason not to.
That's absurd, yeah. But like, it's actually more like, okay, it's a 7% coupon that's trading at 180 or 150 or 200.
Yeah, I guess there's no way I'm going to get my first coupon payment to cover my investment, which there's no reason it should because
well, but usually you can't
sell you something for less than I'm going to receive from them next week, right? It's dumb. But.
And usually, like when you buy bonds, like if you buy from the issuer, you don't buy one bond. Like you buy
bundles of 1,000.
Yeah, exactly.
$1,000 bundles of 1,000.
So if you buy 1,000 bonds that trade at 170, it's 170 grand. But still, I mean. At the end of the day,
which there may be a market at that point.
Yeah, if on maturity date they do actually, pay back the par value of the bond, that's not a bad trade.
That's a fantastic trade. And that's I guess suppose like within 2 years you make back your premium or you make back what you paid.
Right, exactly. Yeah, just based on the coupon payment. So. But obviously that's a very risky trade. I don't know.
It's also an unsustainable business model if you're the issuer of that script.
Absolutely, yeah. I mean, if you're going to pay that much to borrow money, if you're going to pay that much to borrow money, that's just absurd.
All I'm hearing is why won't anyone else loan you money?
Yeah.
Why are you coming to my loan?
Oh, absolutely. Absolutely. That would scream at you. But I mean, so what happens? Like, do the institutions that are currently already loaned money to China, I mean, what's going to happen to those debt assets?
Well, if they're secured, they can always go in and seize the property that's securing the bond.
Okay. So I guess that's kind of the risk is, whether or not it's secured or unsecured.
Yeah. And so the next thing is like you assume that a lot of these companies that are buying these bundles up, they either see the ability to repay at coupon, which will cover their losses when they inevitably, because they'll put the book value as what they bought, but what they bought at a steep discount.
Yeah, massive discount.
And so they'll take the interest revenue, the coupon revenue, and they'll put that into actual revenue. But what'll happen in the end is, well, no, if as an accountant, I'd say that probably what's going to happen is you value the thing on your books as the price you paid for it.
How does that make any sense, though?
Well, because I can't put it on my books at its terminal value because it's a bond.
But what I'm saying is, why can't, like, if you're an accountant, why can't you value it at what it's currently being traded at? Since it's a publicly traded bond.
So you can in theory. So you can actually do that with certain securities. You can say, well, it's currently trading at this, so I can update my balance sheet at any given time. Yeah. And you see that with a lot of like hedge funds and stuff. They update their balance sheet to show that like, hey, our stocks have gone up or our stocks have gone down. This changes the value of the asset because it's technically...
but do that with bonds. So
But with a bond, what you'd normally see is you'd see the bond coming onto the books as a bond receivable or payments receivable, along with coupons receivable, which then count the revenue. But with a bond, what you do is you just put it on your books as a bond at whatever value you paid for it, or at least you should. And then you don't, like, it doesn't convert to its full value until the coupon's actually paid.
That is
and
absurd.
That's when you receive all the cash. So the cash floods in.
The principal technically, if you want to call it that.
The par value of the bond with the last coupon payment come in, your assets increase. You decrease your assets by the value of the bond, essentially what you paid for it. And then the difference is what you consider gain. You just call it gain.
Yeah. So
gain on investment.
I have two issues with that. And obviously, you don't make the rules. I don't make the rules. I'm not saying I have an issue with the way you would value the bond if you saw on someone's balance sheet. My issue, though, is, so one of the things I think that's going on with the Chinese bond markets is that, or the Chinese real estate debt markets, is that there's massive liquidity issues. There's liquidity issues in all bond markets.
Yeah, well, that's the issue. Is you're sitting here looking at it, you're like, okay, there's liquidity issue. There's actually going concern issues for almost all of these developers. But when we say going concern issues, we mean these companies. I'm not entirely convinced that they will still be around next year or 5 years from now.
But at the same time,
current trends continue.
Yeah, but at the same time, on the flip side of that, it's if a company were to look at its balance sheet and it's our assets are this, but the value of the bonds are this, but because they're bonds, they're actually valued like this because at this date, our
payable, they're valued very differently. Payable, they're valued at the face value plus any
but why
all coupon payments.
That's what I'm saying. There's a massive, obviously in this situation, there's a massive discrepancy between face value of the bond and the actual market value of the bond.
Yeah.
So
okay, hang on. Okay, I think
that's what I'm saying. That's my other big problem.
So when I issue
there's liquidity issues and then there's the face value. I
report that as a liability of face value plus any unamortized coupon payments or payments out. Oh. So always does a bond show up on your balance sheet more harshly on the liability side.
But what if you had to get rid of it? What if you had to get rid of it because you had because something happened to your company?
What do you mean if I had to?
What if you had to get rid of those bonds that have decreased so much in value? That when you bought it, that you bought it, and if you wanted to turn around to the secondary market and sell it, you're going to sell it for way less than you bought it for.
Okay, so and so that's the big reason is why when you buy bonds, they go onto your balance sheet as what you paid for them, not what their actual face value is.
Yeah,
and it's because I show the gain when it's realized.
Yeah, but what if you paid for it and it's less, and the value of the bond is less than what you paid for it? That's what I'm saying.
A loss. So say I buy at a discount for $500 and I sell it and I sell again $400 into the market. I show a $100 loss. I say the sale of asset $400. So I remove an asset that's worth $500. So I would on my balance sheet. I would debit $400 cash. I would credit $500 bond receivable, and I would debit with the cash a $100 loss on investment income.
Yeah, but I'm saying before you get rid of the bond. So let's say it's trading at $400. What happens if you had to do a quick valuation on the asset or liability side of your balance sheet?
Oh, a quick valuation. Someone would sit here and they would probably use the market price. They would say, they bought it at $500. It's currently trading at $400.
Okay, well that makes me feel a little bit better then.
They would use that because the quick valuation is I have to turn this into cash tomorrow, which means I use the value that the market is currently trading at. That same thing. I might have it on my book as $500. The market might say it's worth $700, but I can't use that gain except in a quick valuation. If someone looking at it going, hey, if we bought the company today and sold that bond tomorrow, we'd make $200 off that bond alone. Yeah, the company will not appreciate the value of a bond on its books like that, nor decrease the value of the bond on its books just because it swings intraday.
Yeah.
In the end, they'll just hold it, and it doesn't matter until they dispose of the bond, right? So if it gets to the terminal life of the bond and they receive the payment, and they say, okay, well, I bought it for $500. I received my $1,000 and my $20 coupon, so I'm going to show interest revenue of $20. I'm going to show $1,000 debit to cash, a credit $500 to bond, and a credit $500 gain on investment.
Oh, okay.
Right, well, to my revenue accounts.
I feel like the whole situation in China, the way it's playing it out, I think it's. You look at the bank stocks.
They don't have the cash. If they don't have the cash, it doesn't matter what you do. But
if you look at the bank stocks in the U.S., the bank stocks have gotten crushed year to date. And I think really since February, anything financials have gotten crushed. That's why a lot of bank stocks, like Goldman for a while, was trading one to book.
Well, it's because they have their fingers in a lot of gyoza.
Yeah. So I think, pulling the conversation back to the States, it's okay, well, Goldman, who the stock I just mentioned earlier, Goldman just increased their forecast default rates or whatever it is from 19 to 30, let's just say 32%. Because of that, who honestly lends money to Chinese real estate markets?
I wouldn't.
But think about who has exposure there, like the people that have taken on those loans. But it's a lot of like Bank of America, JP Morgan, Goldman Sachs. Those guys have lent money there.
Yeah,
I'm pretty sure. Of course, absolutely. There's no way they haven't.
So that risk from the Chinese markets is contaminating U.S. investment banks.
So that's what I'm saying. Like that's what I'm trying to. That's how I'm trying to pull it back to the States. Is like, okay, the financials have gotten crushed. In case you guys have missed this, last Friday, and I was actually on a plane last Friday, so I kind of missed it too. But last Friday, we entered into a bear market cycle. Was it led by financials? Was it led by tech? I'll let you be the judge of that. But there it was. Bear market began.
No, they both went into it.
And all of last week, it kind of flirted with it, right? Like there were, I saw that thing by Zero Hedge. It said 2 times last week, the ES, which is /ES. That's the ticker symbol if you're like on some trading platform. That's the ticker symbol for S&P minis, the futures.
Yeah. Did they? I don't know. I think
it barely touched that level. Like so, the bear market level was 38.56, and it bounced and twice last week. It touched it and it bounced right back up. And then on Friday,
that tells me that there was probably a lot of algorithms saying if we hit this point, which we can't, which historically was the low. So we'll say, okay, we'll hit that and we'll start buying. But the thing is that only lasts as long as the capital lasts to buy at that point. Yeah. And if things keep trending down, that point doesn't stay hard. It drops below.
Yeah.
Because people see the ground because the banks, the algos see that the market is shifting beneath their feet. They have finite capital to pour in. Yeah. So you have to look for the bigger discount.
Yeah. And speaking of that cash that's available for them to buy these things, I mean, like the first time in history, which I think was this weekend, first time in history, and when I say this last weekend, I mean like, what was it? Today's the 25th. I think on Monday, the 23rd, May 23rd, biggest reverse repo program in the history of repo programs was announced. And apparently the New York Fed announced over a $2 trillion reverse repo program.
I mean, because this week has been interesting because starting this week, we've seen that. It's not just this week. It's just reached a point where it's like, consistently with the weird markets, we're seeing the reverse repo market has been through the roof for the last 2 months. Really,
well, it's like over and over again.
Just banks buying overnight bonds, going like, hey, we'll give you cash.
Yeah, well, it's like over and over again.
80 basis points, but at the same time, right now, think about it. Like, what is the investment rate right now? 50 to 75 basis points.
Yeah, that's what the current rate is.
All right. Well, the overnight rate is 80 basis points. So it's still. Somehow that's a better deal.
Yeah,
it's a better deal.
Yeah, well, the ridiculous thing about the repo markets is like I've never seen the repo markets this active, especially the reverse repo.
No, this is consistently active. Yeah, so you see,
but it's like every other week. Every other week, it's it's $1.5 trillion. I mean, like I remember when they first announced a $1 trillion reverse repo program, and I was like, "What just happened?"
Yeah, why is there so much cash that's looking to buy up overnight in? Investments in just
but why is the Fed? I mean, because why is the Fed trying to suck money out of the financial institutions like that, and then just only for
the Fed isn't. I think it's just the banks are trying to get their money. What they're seeing is they're not seeing an ability to. I think the banks are seeing an inability. Banks, financial institutions are seeing an inability to invest the money in a way that makes more than this. So they're going, well, that's a guaranteed 80 basis points. Let's go overnight with the Fed.
So you think it's initiated by the recipient side? So the market participants?
I do. I think market participants are sitting here going, there's too much money. This is a way to make some, to underpin, especially in a market where...
I honestly looked at it from the other side. I'll be dead honest with you. I'm sorry to cut you off, but...
The Fed wants this too. The Fed would want this too, to remove liquidity from the markets.
Yeah, it's just so short term. It's so weird how both
sides gain from this. In that the financial institutions are making more than they could any other overnight transaction, right? Because 80 basis points is better than 75.
Yeah,
and then the Fed is also sitting here going, well, we do need to pull money out of the markets.
Well, so because the Fed is
both parties are served.
Yeah, because the Fed is really facing two issues right now. They're sitting on because they auction all these treasuries and nobody buys them. So there's that issue. They have too many assets. And then the second issue that they also have is, the cash supply out in the economy is massive and it's not sustainable. So what we need to do is take away the cash supply. Also, we can solve our liquidity issues with our treasuries by, and think about what a reverse repo does, right? So in a reverse repo program, a market participant, they lend cash to the Fed. What they do when they lend cash to the Fed is that the Fed gives them an asset. They have to give them something.
Treasuries.
They give them treasuries. So now treasuries not on the books of the Fed, cash out of the economy. It's solving two problems at once right there.
Exactly.
So, and then of course, like it's a repo program. So like not long after, it's got to be, okay, well, the banks have to buy the treasuries back. So essentially what you're doing is every week you're kicking the can down the road.
Treasuries back.
Yeah, well, essentially that's what it is, right? So like, because like a direct repo is like me going up to you because you need money overnight, and me.
I'm sorry, no, you're absolutely right. I misspoke. Yeah. I said buy the treasuries back, didn't I?
Yeah, no.
You're right. They take control of the bonds, but they're selling them back later at the agreed upon 80 basis points. Yeah,
exactly. Yeah, I thought that's what you said. I thought you said it's like, okay, the banks are buying back the treasuries from the Fed when they get their Yeah, sorry. The Fed is.
They are. That's what they're doing, and then later they sell them back for cash.
Yeah, and the Fed buys them. That's okay. So now I just said it wrong too. So I forgive you. Yeah, but like a repo is just basically like, okay, James, you need money overnight to get new tires on your car. I go over to your house. I look around. I buy your bike from you for like $500 or whatever it is. You go and get new tires, and then you go work a shift at the bar, and then you make $500, and then you come back to me, and then you buy back your bike. That's what a reverse repo
for $503,
right?
$540. 8%. 8%. I'm saying 8%, not 80 basis points. So yeah, no, it would have been $503. Yeah,
no, $504.
At 80 basis points.
Yeah, so you go work a shift to the bar. You make however much money you make, and you take $504 of that, and you give it to me and say, hey, I want to buy my bike back. That's exactly what a repo program is. But I think it's like, is it overnight or is it like 3 days?
It can be. It all depends. It all depends on the repo in question. They're all short term, extremely short term.
It's very, very. It's like 1 week, if that. But to me, it's like $2 trillion. They can do this with $2 trillion. This is insane. You know what I mean? Because I'm like, remember like last year when it came out, like we did an episode on this.
Yeah, right before the market downturn, there was a major.
Yeah, it was like during the whole SPAC craze. It was like right after that. I mean, like. So I think it was like December, of 2020 or maybe like early 2021, but it was like the first ever repo program that crossed over $1 trillion. Oh, no, it was a reverse repo. It was a reverse repo program. Market participants ended up lending money to the Federal Reserve in excess of $1 trillion. And we were both like, what just happened here?
Yeah. And why?
Yeah. So I think in this situation, it's very clear why now, because for a long time they were talking about liquidity concerns for treasuries. Mm-hmm. I'm assuming the underlying asset that they made, like for instance, the bike in our situation, me buying the bike from you, like in this situation, it was the Fed saying, hey, the assets you got to choose are anything less than 2 years, right? All the treasuries.
Yeah.
So, and banks are just like, all right, we'll take these off your books and then we'll go from there. And I think the Fed does this I feel like the Fed does this every single time.
Every day. They just go to the open market. They just go to the open market desk to contract these trades.
Yeah, exactly. And I think it's especially done whenever there's a really bad bond auction, which nowadays happens every time there's a bond auction.
It's often.
So I think it's kind of fishy. Does it solve any problems? Yes, but for like 2 seconds. It's like a cortisone shot. It's like a football player with a ruptured disc or something like that takes a cortisone shot and goes out and plays the second half of a game. That's like what it is.
Oh yeah. Concerningly accurate, unfortunately. Because it solves the immediate issue, which is to say discomfort. It doesn't actually solve the problem, which is you have a ruptured disc. You have actually a liquidity problem. In this case,
you have a functioning problem.
Too much liquidity.
Yeah, in this case, it's the opposite, right? Just too much liquidity. We got to get that out. And yeah. Speaking of discomfort, as good a time as any to move on over to retail and consumer sentiment.
Yeah, I'm gonna need a beer for that.
Yeah, I know. Same here. So give me 1 second. Let me find a beer in this ice bowl. Is that a Yingling as well? Is that a Yingling?
Yeah, it is.
Man, I should have got the glass bottles. I don't know why. The tall boy can, the pint.
No, dude, the pint can. I understand.
What a beautiful bottle.
I understand.
It's a deal.
Here's the worst part. So I love a pint of Yingling, but I do think 12 ounces should come in a glass bottle.
I feel like 16 ounces should come in a glass bottle.
I think glass tastes better.
Absolutely, it does.
There's a metal taste that comes with the metal. But here's my thing. I do think that 16 ounces should come in that bottle shape while you're currently drinking. I think that's better than a tall boy.
All right. You've convinced me, dude. I'm going to pour this into a glass. Here we go.
Shit, I didn't tell you to be classy. I told you to be less gracious.
Well, there's a cocktail of both going on right now. Oh, look at that color, man. That's beautiful, isn't it?
You know what?
Look at that.
Isn't it?
Right? It's fantastic. It's fantastic and beautiful, unlike what's going on in retail, which has been pretty interesting.
Yeah, if you're not Nordstrom.
Well, the thing is,
Target numbers were shit. Amazon's numbers were shit.
Walmart,
yeah. Their numbers, their retail numbers were bad. Their guidance was not encouraging. Abercrombie and Fitch, they posted a loss. They were and then they gave it an incredibly anemic. not even anemic. They give a week outlook, and they're down. They were down 30% on Monday from that. After that,
who is this?
The only one I've seen the last 3 days this week that's been up has been Nordstrom.
Yeah, I think Dick's was up too.
That makes some sense.
Yeah, but the crazy thing is, I think Best Buy actually. I mean, they're a company that went up too. I mean, like
it wasn't
retail
great news. They missed their earnings. They missed their EPS barely. It was like 4 cents.
Yeah, but they also said like they braced themselves for, which I'm like, why didn't everybody else do it? But they said they kind of braced themselves because the CEO, whoever it was able to at least like prepare their inventories and all that kind of stuff based on whatever the consumer sentiment data and consumer confidence data is.
Well, I think that's Best Buy's also moved. If you look at like, Best Buy 3-4 years ago made a pretty big move into also being kind of a consignment holder for a lot of stuff. So like DVDs, music, CD music, a lot of like that smaller stuff that historically they would have had to buy and would have taken up their inventory dollars and their inventory space. They've moved to more of a consignment basis where they assume no ownership from an asset perspective of the things, but they have control of it for sale purposes. And to me, that was actually when I saw Best Buy doing that, I went, okay, they're getting smart. They're taking all these small things that like, you're probably not making a huge amount of money off of it. But you're making some of every sale you make can just be profit if you don't take ownership and control of all of it. So So it's that like
so they assume less of the risk.
It'd be like if Blockbuster decided that it was tired of selling like the movie theater was like, you know what, we're gonna keep selling candy at these prices, but we're tired of buying the candy for ourselves. So it's just they're like, hey, do you want to sell candy in our store? We'll sell it for you. You just have to give us, the difference of what the taste of your sale.
Yeah, so like Nestle went up and set up a shop in all the movie theaters, in like all the AMCs, right? Kind of like that.
It's just like Nestle. Like when we sell, we'll remit onto you what we sold, like the amount that you were going to sell it for, but we're not going to buy it from you first. We're not going to buy it from you.
Oh, okay, yeah. So that definitely helps a lot too.
It's that you just park your inventory here, and we will eventually sell it.
So they're like wholesalers.
Or you can take it back.
So they're kind of
exactly.
Yeah, it's kind of like a wholesaler.
And that's what they've done for all their small stuff. So they did that for like I said, for CDs, for DVDs, for video games. I think they tried to do that with appliances, which again is a very, very smart business. If you're sitting at a point going, we can't compete with Amazon. Well, instead, maybe it's like, okay, we'll become a showroom for someone else and then just collect on their behalf and keep
gotcha. So they're essentially they're like a bigger trade show.
Mm-hmm.
Okay, so I feel like that's why the inventory issues, because if you think about what consumer sentiment really is, I mean, it's essentially just like a survey of consumers. Like the consumers think, which like I do put a little bit of weight into consumer sentiment since I do think it's like kind of important in terms of economic outlook and forecast.
Oh yeah, but even someone who can't afford to do something is a great window into consumer sentiment because you get things like you might get someone on the phone and be like, hey, would you be willing to buy a TV tomorrow? And they might be like,
or are you going to buy a TV in the next 5 years? Right? Do you see yourself buying a TV or a computer in the next 5? I mean, consumer sentiment. The survey is like very detailed. It's super detailed. It's like you're going to buy a car.
It's like, hey, if you had $1,000 right now, would you be willing to go out and buy a TV? And if someone's like, that's like, oh, hang on. We just gave you free money. Why aren't you out to buy a TV? And suddenly when people are like, if you had $1,000, would you go out and buy a TV? And someone goes, hell yeah. You've either got an idiot or you've got someone who's got a great idea of the pulse of consumer sentiment, right? Because I'm sure there was some guy like in 2008 who was like, I haven't made a mortgage payment in 8 months. Ooh, a new TV. Woo.
Yeah.
Like it's possible.
I mean, but this earnings cycle has just been brutal. Like it's, so I think this is kind of like a two-pronged. Yeah. I mean, this is kind of like, there's like kind of a fork in the road for us to talk about right now. There's, the retail earnings, which if there was any signs of weakness in your earnings report, the market was going to kill your stock. Just sorry. Too bad. But if your report came in relatively strong, they might reward you a little bit. Like it had to be super strong for the market to actually reward you. But in this market, I mean, consumer sentiment has just been declining like you wouldn't believe.
But that makes sense though, doesn't it? Like,
no, absolutely it does. Because think about what's going on. Like GDP growth is negative. It was negative, and I'd be so shocked if it came in not negative in this next quarter, which wraps up in a month, which is insane.
Unless they do some kind of market number fuckery. Because what they say, there's lies, damn lies, and statistics.
Yeah, which are kind of all the same thing. If if the Federal Reserve is running it, the Bureau of Labor Statistics, but like I'd be really shocked if there wasn't a negative GDP growth print in the next quarter. I mean, if it came in at like a 0.1% 1%, then I'd be like, all right, fine. Someone did something to, make it look like there wasn't 2.
Someone screwed around with some numbers so they didn't have to do a recession, but that's
exactly.
it.
But I mean, it's kind of like referring back to the article that I wrote that I posted on LinkedIn. It's, stock market is showing signs of surrender, but consumer sentiment and confidence is really weakening. And the labor market is actually like employment numbers have been looking weaker and weaker and weaker every single week. So,
well, it's because I think that's
week
actually
and week in the same sentence, but wow, yeah.
I think that has to do with the inflation numbers, and it's just because you got
absolutely, and we have inflation. The
demand for employees is still very clearly there, and it was stronger than it was 2 weeks ago, a month ago, even 2 months ago, even.
Yeah, but if you look at it, from like November, I'm saying like if you look at it from November till now,
to hire anymore. They can't afford to hire at the current market rate, and it's that very interesting point of like the labor market's not weaker, the ability to afford it is weaker. And it just like why are so many of these retailers in rough shape? It's because everything's more expensive than it was before. I mean, inflation hits the poor people first. And so why is consumer sentiment down?
Yeah.
It's down because, consumers were willing to buy no matter what through the last 9 months because they could afford to, less and less so each time.
Yeah.
But finally, we've gotten to a point where the consumer can no longer prop up the economy, as we saw with the GDP shrinkage.
Right.
The consumer can no longer prop up the economy when inflation is this bad.
Yeah. Well, and I'm looking at the consumer sentiment chart, right? So it's essentially what happened was, okay, I don't know what 100 is. I'm assuming 100 is max confidence based on some value that was determined back in 1966 or something like that. But it was pretty close to 100 back in 2020 before COVID hit. It's a monthly survey, so it comes out once a month. Like, it's not like we know exactly what consumer sentiment is now. It comes out like every single month. So based on what happened in the last 2 years, so COVID started, consumer sentiment obviously dropped so it looks like it dropped to 70. And then it went back up a little bit to like 82-ish, I think is what that peaked at. And that was around early middle 2021. And then it just went straight back down. And now it's at like
inflation's
60.
been really bad since mid 2021 is about when inflation started to stopped creeping and it started just like walking openly in the street.
Yeah. It started walking with inflation just was like, I don't care, I'll go shrieking.
It's the alligator on the golf course. It used to be nervous and stick near the water trap. Now it's on the green saying what? Yeah, what are you gonna do? Try making birdie with me here. Bring it. It's hole in one or nothing. Which actually, not putting on my green.
I'm not even kidding, dude. I had this incident happen to me. I mean, it's not like a gator on the green, but when I played in a tournament in Florida, like with Nebraska, I was with the University of Nebraska, and I was like, did I sign a waiver if I got attacked by an alligator? I don't know if I did.
Probably not.
Yeah. Anyways,
it would have been if you'd agreed to play college golf in Florida.
Probably would have been. It most definitely would have been. But we had a tournament in Florida. I hit a terrible drive, and it was right next to the lake. And as I was walking up, I saw an alligator. The alligator saw me, and then it jumped into the lake. And I was like, now I got to hit the 6-iron with knowing that alligator just went into the lake.
There's an alligator in that lake that I cannot currently see.
That literally just went in there, and I was, and you can't see it. So I'm like, oh, man. So I literally just like put my bag down, hit my 6-iron as fast as I could, and I ran away from the lake. And it was, I don't even know where the shot ended up. I was so scared, of my life.
You probably said to some Floridian, like, there's a gator in that lake? And he probably went, there's more than one.
Dude, just you want to know the crazy thing? You want to know what the event was called the
Gator Open?
No, it was called the Big Ten Match Play. So nobody there was from Florida. I mean, maybe there was a golfer from Michigan from Florida. I don't know, but it was the Big Ten Match Play, and they hosted it in Florida of all places. And there's gators everywhere there.
Yes, that checks out.
Yeah. But anyways, like back to consumer sentiment, like the last print that we saw, which was month of April, came in at 59.1% or whatever it was.
I think so, which is quite a bit down from 70 for those.
Well, I mean, So, I mean, that was like the weakest since like 2012. That's the weakest it's been. And in case you're wondering how they measure it, it's a bunch of questions that I think the survey is done by Thomas Reuters and our big enemy, the University of Michigan. So the enemy. So I mean, one, the credibility. I mean, it's done by the University of Michigan. So being Nebraska folks, why would anybody trust the University of Michigan?
Look, they're stuck inside for a long winter. They got nothing better to do than call people on the phone.
But the weird thing is, a lot of economists actually looked at, I don't know who popularized it, and I forget when exactly it was popularized. I think it was popularized in the 1960s or something like that. But a lot of economists look to this thing as like how well the economy is doing.
Well, yeah, because right, we talked about spirit animals a few weeks ago, and it's the animal spirits, not the spirit animals.
Well, we talk about it all the time. I love talking about it. Yeah.
But this is getting a measure of people's animal spirits at any given time, right? Because that's when it starts. Like the day people, if everyone's like, yeah, things are great, things are going to be great the next day. But what if tomorrow, like, there's a witch burning and like everyone's like, oh my god, no, everything's bad. There's a witch. Like, suddenly it's like, oh god, well, what happened? Because that's better anyway. But that's the thing is it can turn on a dime. It could be that Nike puts out an article revealing that they actually
great movie. Sorry,
it really is.
It's Monty Python. That's a great movie.
The Holy Grail, folks. For those of you that don't know, you must do some research. Go watch it.
God, I love that scene. That's such a great scene. It made me laugh so hard.
The witch trial. It's concerningly scientific.
It really is. That scene is. But like, yeah, I mean, it's like, obviously, is consumer sentiment the only economic indicator? No. There's things like employment, inflation, fun fact, supply chain issues, all that kind of stuff.
Oh, yeah. But we also need to remember that the economy and the markets are not the same thing.
Yeah. But it goes to the animal spirits.
They're correlated, but they're not.
Yeah, they're correlated.
They're certainly correlated, but they need and they're in theoretically causal, but only in one direction. The economy causes change in financial markets. Financial market change there's a correlation between it and the economy. The economy has a causal relationship with the markets. It is a one-way street.
Yeah, exactly. The only time it'll actually cause anything is like, okay, if all of a sudden someone raised so much money from equity financing that actually, and then the ROI on that was insane. But it's rare.
That's how you break the economy. But that's such an outlier that you'd be breaking.
Yeah, it's rare.
Just multiple principles of economics. And
exactly. It'd be insane. I mean, and it can happen with the financial sector every now and then, but
that's why you've got a guy who's sinking a lot of money into trying to buy Twitter and is now complaining about something that he should have known beforehand, or at least before he made the tender offer.
Yeah, but basically, just to tie a bow on the consumer sentiment thing, it's going off the animal spirits. It's like, okay, manufacturers will look at the consumer sentiment and go, okay, this is how much we need to produce because our buyers, our distributors.
There's a market for steel. Yeah, there's a market for new cars. There's a market for toys. So let's make more of that lead-based paint.
Yeah, we don't need to mine as much copper because there's not as many people that are going to use the copper to put it into.
People are moving to LED light bulbs. Okay, we can lay back on our copper production because we don't need that for light bulbs anymore.
And then from there, on top of that, not only is it something that manufacturers look at, but it's also one of those things where businesses, when it comes to like managing their inventories, they look at this data and they go, if the consumer sentiment is at 59 point whatever it is, like, okay, well, we're not going to buy as many things from NVIDIA, let's just say, for example, or AMD, because we're not going to make as many computers or as many TVs or as many smart cars or whatever it is, refrigerators. Because there's no demand for it. Consumer sentiment is weak. No one's buying anything that they don't need to buy.
Yeah.
That's essentially what it is. That's the animal spirits. There's no witch burning.
I don't know if that's good or bad. I've learned some things about trees. So, trees for liquor purposes. So I found out that in order to make wine, the average tree that gets turned into a barrel is 150 to 200 years old.
No kidding?
Yeah, before it's capable of being a barrel quality tree.
That is absurd.
200 years is a long time, and I like wine and liquor.
I like wine quite a bit, and I like liquor. I like whiskey quite a bit.
Absolutely, and they need fresh trees that need to be 200 years old.
Yeah, it's so weird. Wow. Do you think one of the questions they ask in the consumer sentiment data is like, hey, would you buy a bottle of whiskey right now?
So or
would you buy alcohol?
It probably is a question.
It's got to be a question. It's
similar.
Because you would think like alcohol is so recession proof, but the weird thing about like consumer sentiment is like it's very divisive based on political party, right? So if you ask Democrats, they'll give you one answer. Republicans will give you another answer. Yeah. And if you think about like religious reasons, people that do drink and don't drink.
Well, yeah, I guess you have to be questions to kind of like generate like, oh, is there a reason you're not buying that? You couldn't ask a Hindu if they're going to eat a hamburger tomorrow, and you can't ask a Muslim.
Yeah, exactly.
Or if they're going to eat beef or drink coffee.
But do they know? Do they know like who they're interviewing, or is it just like?
I think they have to ask. I think they probably ask, or they probably suspect if they're calling people in Utah, they've got a very high likelihood of running into a Mormon.
Well, I think that's the reason why they know that. Okay, Republicans say this during this time, and Democrats say this during this time, right?
Yeah.
Because obviously, like, okay, if you're a Democrat right now with this current administration, it's like, okay, you want to support this administration, so you'd rather give them a better answer, right? And that's the same with Republicans too. Like when Trump was in office, I'm sure Republicans that were polled during the survey, whenever it was announced or whatever it was, I'm sure they answered in a way that made the president look a little bit more favorable. I don't know, maybe, probably, but it's just weird that like Republicans will say one thing and Democrats will say another thing. Depending on who, consumer sentiment's always like that. It's always divided. Like Republicans are way up or down, and then Democrats are in the opposite direction.
Which is why they probably ask simple questions like, would you buy a gallon of milk? And right now it's like, well, if only I could run my car on it because it'd be cheaper. Have to be said, milk is still very expensive.
It's still very expensive. But that's just because livestock is very expensive.
Now, I guess that brings me really weird turning point in the evening, which is...
Are you trying to refer to something that isn't expensive?
I am. And it's... what's
not expensive?
It is in fact our merch. Our merch I don't think is that expensive. I think it's pure
fair
quality
valued.
and at a fantastic
Unlike
price.
Twitter.
Absolutely. To be fair, the price for me is still the price that's right, free.
Free 99 is my favorite.
If you check us out at drunkenomics.myspreadshop.com, you can find some pretty sweet merchandise.
That's what
it has been a little harder for me than I'd initially anticipated to get the new merchandise stuff up, so we're running behind on that. I know I said it would. I think I said it would be up by this week, and it's unfortunate it's not going to be. And I'll be honest, I didn't.
Well, aren't you meeting with that person this week?
And last week, and
nice.
And it's at this point it'll be up and it'll be up soon. I promise. It's just that we had the meeting, everything was good, and then I just didn't get the stuff in time to upload it to merchandise or set merchandise up. So that's on me.
No worries.
We will get it up. We will get it for you, and we still think the price will be good.
And then from there, check out our Patreon as well. patreon.com if you want to help us continue to play Chestnut Checkers, continue to keep up that drunkenomical behavior, and also, of course, keep the liquor cabinet stocked.
The ice cold, which is just very important here. It's much more important here in Florida than it is up in Nebraska, at least at this point of the year. I've gone from 65 degrees to 91 degrees, folks. And
well, dude, I had to ice my hand earlier because I was hitting the heavy bag, remember?
That's true.
Come on, it's that and the whiskey on the rocks.
Honest, guys,
come on.
If the only gym to go to is Jim Beam, then you're definitely behind. You're with me in my heart. If the only gym, if you do more than one gym, then that's definitely Aaron's bailiwick. You can talk to him about that. But,
former competitive powerlifter here.
We do have to break the news that I'm already on vacation.
But this is the thing, James. Like you said, as long as you're playing chestnut checkers, filling and killing, I forget what else.
Staying drunkenomical.
Yeah, and as long as you're staying drunkenomical, man.
Everything's good.
Enjoy the rest of your vacation. Cheers, bro.
Cheers.